Principle 5, no demand in a downtrend. This is very important. This is the best place to short. This will be an up bar on volume less than the previous 2 bars. This indicates lack of demand from professional money. It is important that this principle, called no demand, is on an up bar, okay, a bar that closes higher than the bar behind it. And for the best short, it should appear after a major sign of weakness and in a downtrending market. Now focus on that. We'll send you this slide. This is important to follow these rules. After seeing a no demand bar, do not sell at market, but place a sell stop below the bottom of the no demand bar. That means the market comes to you. You are not trying to buy market when you could have 2 or 3 no demand bars moving up as they withdraw their interest. And it's not uncommon to see no demand followed by an upthrust, which would put you under serious pressure. Here we have examples of where no demand bars are in the right place. Now we see we've got supply on that first bar. We see very, very high volume on an up bar. Okay, and we know, because the next bar is down here, that there has to be some sellers in there. Now we'll look at the volume declining as the market rises, and we've got weakness in the background up at the top here. This comes off, we get supply hit the market, they try to take this top of this bar out, but the volume declines. This bar here takes you into the trade, okay, just below this bar here. And at that point your stop would go above the no demand bar. Again, I trade the S&P, so I'm using quite wide stops, but because you've got this old area to the left, you'd place your stop just above it, and then you let the market run. Now generally when you see no demand after this amount of supply, the market will not go through that no demand bar and your stop should be safe. Again, you've got to have the downtrend in place. You've got to have some sort of weakness behind you. Philip, anything you want to add to that example?
I don't think so. I think you've covered that perfectly.
Yeah, okay. So let's look at another example. All right. Now here we have, again, some serious weakness on these bars here. Look at the volume here. We get a lovely level bar. It's slightly higher here on... Oh, sorry. That's better. So here, let's go back. We have this widespread bar here, ultra high volume. This is one of your stocks, Philip, TCG, which is a UK stock. The market begins to mushroom over very quickly, in fact, because of the supply. We see this yellow area here is all the weak bars coming in. Okay, there's a lot of weakness up here, hidden up thrust, look, just here. Okay, that we just talked about. And then because of that, the market rolls. We begin to make lower highs on the bar. That tells you, okay, that we're actually, now if you use Tom's trending system here, you'll see exactly what we talked about. We have lower close, lower close, lower close, allow one up bar. Lower close, almost level, ignore it. Lower close, higher close. Uh-oh, second higher close, the volume is reducing, I'm safe. Close lower, we're good, and off we go, off to the races. Tom, that really does show how the trending system operates on the short side. Now, again, when someone's short and the price goes up, their immediate natural human instinct is to say, I had $1,000, I've only got 600 now because it's ticking up against me. What would you tell them in something like that situation?
Well, you mustn't look at the numbers, really. You need to look at the chart very, very carefully. And if it's going up on no demand, then you know you're safe. You could stay in that trade. But we can't tell individual people how to trade. I'm afraid that's something you have to learn. Or what we're here for is to teach you and show you the low risk areas where you can either enter the market or exit the market or enter a short position in the market. That's our main concern here. It'd be a nightmare if we started trying to tell everybody how to trade.
Well, you know something, that there's different types of human beings, Tom. I think there's 4 different types, but they're broken into many types.
Yeah.
I think the reason that so many people lose money when they buy systems is there are people out there, the snake oil, that say, look, just buy our system, whether you're a genius, whether you've never traded, but our system takes all the guesswork away, it's all green and red, or whatever it is. And unfortunately what happens is people think, well, look, the market can't be difficult to trade, Tom. It goes up, down, or sideways.
Yeah.
I mean, how many times have we had pilots, doctors, lawyers, very intelligent people come to the market and say, well, look, this looks easy. Philip, it can't be difficult. It goes up, down, or sideways. It's easier than gambling. And of course, then they lose their accounts. They say, well, that doesn't seem right.
What's the lack of homework? Sorry, Tom.
What it doesn't occur to them is that all the information they've been gathering as they would in any other business, is misleading them. It's the wrong information. If you've got a highly intelligent guy and he puts several years into studying the market and he still can't make money, then obviously the information he's been taking in cannot be helping him. And that's why I say you'll never get anything from the market, from the exchanges, anywhere that's going to help you. They definitely won't do that.
Tom, can I ask you a question? Why is it the self-regulated exchanges throughout the world, including you talk about the London Exchange, they don't release that true volume information until the next day? Now, must be a reason for that.
Longer.
Or longer.
Or longer, yeah. They're notorious like that in London, apparently. Of course, the reason is that, don't forget, these exchanges are private clubs, and the rules are made by the members. And why should they're not there to help you, they're there to make money. That's their main concern. And if they can hold back the volume, they'll do it.
Now, Robert, I'm going to correct you here, Robert. Now, great comment. He says, in the long run, looking back, you can see the downtrend, okay, but the yellow area could be absorption volume with testing. Philip, would you like to tell Robert why there's no test there? There is no test at all. Remember,
I can't see one.
No, there isn't one.
No.
Robert, a test, an ideal test of that will be a down bar, not an up bar. You can get up bar tests, but not like a gap up like this. A down bar test is going to be coming back into the body of this bar, probably below the close anyway. These bars never touch the close. They keep going up on reducing volume. And then you get a narrow spread on this bar, capping the market, and then this bar is down. This cannot be absorption volume. For it to absorb the supply to the left, they wouldn't just keep marking it up like that. That would be weak. They would bring the price back into this area here, into this bar, and they would test it. And we'll show that setup when we come to signs of strength shortly, because a test in the right place will show you it. So you'll see that later. But this cannot be a test anywhere in here. You've got a serious sign of weakness, and then you've got an up thrust right here. There is no test at all in here. This is, if you were to put W over weak bars here, every one of these bars would be a sign of weakness. I don't see, apart from that bar, which you might look at as a test, but I have to say, even then, with this in the background, I could not see that as a test bar. And in fact, as we go up, we get a narrow spread on this bar here. The next bar closes down, and that just confirms the selling in there. So that is why that wouldn't be absorption. I hope that is clear, Robert. Janet says, would you short on the high volume upthrust bar because we have the weakness in the background, or would you wait for the hidden upthrust on the 29th of the 9th?
I'd short on that one.
Yeah, no, Tom would be short up here somewhere, but no, I actually, certainly for me, would be taking the short on the low of this bar here. That would be my entry. Philip?
I was wondering if you could short that second blue bar after the yellow
here.
Area.
You could.
It's quite an aggressive trade, that one.
It's aggressive because it's still in an uptrend. Yeah, that's the. I mean, I'm trying to give you. We're trying to give you the best places, the low risk entries. I'm not saying that you couldn't, if you get good experience and you learn VSA, take these trades. Look, Tom and I sat here yesterday in an uptrending market. We saw an upthrust on low volume, and Gary said, "Short that," and I said, "Well, it doesn't meet my criteria. It's an uptrend." He said, "But it's going to come off." And he was absolutely right. Now, that's a decision you make. If you've watched me trade live, I do make occasional losing trades. It's occasionally because what I do is I go against my rule and say, look, let's try it. And lo and behold, I get stopped out. It's happened a few times in the VSA club. Not many, I'm fortunate. But my entry is A, definitely. It's everything. It's no demand, in the right place. Bar A. Philip?
Yep, I'd agree. That's a low risk trade. Can I just come back on one thing you were saying about the possible absorption volume there? Mm-hmm. You've got to remember with the professionals, when they carry out absorption volume, they're going to use the least amount of effort they possibly can to get through that area. They're in business to make money, mm-hmm. and they don't want to use any more effort than they're absolutely forced to. Because if they put a huge amount of effort, it costs them a lot of money. Mm-hmm. So they only want to use enough buying power to get up through there, no more than that.
Yeah, I agree. Now, we're going to talk about absorption volume, Erica, in the next session. So let me take that question and ask it when we get to the signs of strength, because that'll be important. All right, let's summarise. Shorting after you see no demand. This can and does appear in an uptrend, but it's far more powerful in a downtrend, as we've just shown. Do not short on no demand in an uptrend. It's in the wrong place. This is a powerful short when there is a downtrend in place and price goes up to the top of the downtrend channel on no demand. Look for signs of weakness in the background, which we've just seen. This is particularly powerful, and this is where my favourite setup is, where you've got the end of a rising market or a buying climax. That is the very strong one that you can do. There's a couple of questions for you, Philip, here. In terms of placing the trades for end of day traders, Philip, would you short on an opening gap up when there is weakness in the background?
On a gap up?
Would you wait for more confirmation?
I think I'd probably wait for confirmation.
Yeah, I think I would too, definitely.
Yes.
Okay, and Evan says, how about a short below the close of the high volume bar? So Evan's saying, see this high volume bar here, short just below here where it falls through. Well, we were saying, Evan, you wouldn't be far wrong there, because if you saw this bar here, look, it's a very low volume upthrust bar. It is an aggressive trade. You could certainly take it. You put a stop, or you put your sell order in just below the bar behind it if you want to be safe, and you would be taken in there. It's a trade, but we're here to teach you lower risk trades, and I have to say, I'll stress again, it would be the one I'd wait for, especially if I was trading in a live environment, as I do often in these exhibitions. And as you know, I trade as an educator with the CME group, and I make sure that I try to show low risk entries rather than risky entries, because we're trying to make sure that you protect your capital and don't risk your money in the market. I mean, you do risk money, of course you do, but we're going to try to give you low risk entries.